Right now, across Canada, a quiet financial storm is building. One that will hit 2.2 million households before the end of 2026. It's called the mortgage renewal wave, and it's the largest debt repricing event in Canadian history. Over $1.6 trillion in residential mortgage debt is outstanding, and more than 40% of it is about to reset to a brand new interest rate. Homeowners who locked in rock-bottom rates near 2% during the pandemic are now renewing at rates north of 4%. Since January 2025, 82% of Canadians who've renewed are paying more. And today we're breaking down exactly why and what it means for the whole economy. The Bank of Canada has already cut its key rate down to 2.25%. So why are mortgage rates still so high? Because fixed mortgage rates don't follow the central bank directly. They follow government bond yields, which have stayed stubbornly high near 3.2%. Here's the mechanic nobody explains. When your mortgage renews, the bank recalculates your payment using your remaining balance, the new rate, and fewer years left to pay it off. As a rule of thumb, every 1% your rate climbs adds about $50 a month in payments for every $100,000 you still owe. Take a real example. A $500,000 mortgage from 2020. Even after paying down $82,000 in principal, the new payment jumps by almost $500 a month. That's a 22% jump in what a family owes every single month, for a loan they already thought they understood. It's even worse for variable rate borrowers who quietly built up hidden debt during the rate hike years. Some now face payment jumps of over 40%. Young buyers are being hit hardest. 90% of homeowners aged 18 to 34 renewed at a higher rate than before. For over half of them, housing now eats up 50 to 70% of their entire monthly budget, far beyond what any bank considers safe. Foreign-born homeowners face similar pressure, often choosing short, 3-year terms just to stay flexible in an uncertain market. Meanwhile, older homeowners are largely insulated. Smaller balances, decades of built-up equity, and some even renewing at lower rates than before. A rate hike on a mature $150,000 balance is manageable. That same hike on a $450,000 balance can break a family's budget. To cope, nearly 40% of renewing households are cutting back. Less dining out, less travel, fewer non-essential purchases. Multiply that across millions of households, and you get a national economy running in low gear. GDP growth barely scraping past 0.7%. 40% of renewing homeowners want to shop around for a better rate. But a regulatory hurdle called the mortgage stress test often traps them with their current lender. To switch banks, you must requalify at an even higher rate. So many stay put, even if their current lender isn't offering a competitive deal. So far, national defaults remain low, but cracks are showing in the most expensive markets, where mortgage delinquencies are quietly climbing. Instead of foreclosures, banks are quietly stretching loans, extending 25-year mortgages out to 30 or even 35 years to keep payments manageable. It's a financial band-aid, not a solution. But for now, it's holding the system together. So what are smart homeowners doing? Most are avoiding long-term bets, splitting between 5-year and 3-year fixed terms to balance stability and flexibility. Experts recommend starting the renewal conversation at least 120 days early, locking in a rate hold before costs can climb any further. Others are using prepayment privileges, switching to bi-weekly payments, or consolidating high-interest debt directly into their mortgage to soften the blow. And economists agree on one fix regulators could make tomorrow: loosen the stress test for straight renewals, so banks have to compete for your business again. Rates near 2% aren't coming back anytime soon. This is the new normal. And understanding it now is how you stay ahead of it. If your mortgage renews in the next 2 years, don't wait for the letter to arrive. Start the conversation now. Subscribe for more breakdowns like this one.